Mike Brady with Generosity Wealth Management, a comprehensive, full service financial services firm headquartered here in Boulder, Colorado. Although we have offices in Fort Collins as well, and clients throughout the whole United States. So we're coming to you from Boulder right now. This is the year-end video. It's been a wonderful 2024. I'm doing this video, I'm kind of recording this video right before Christmas. I'm sitting here thinking to myself, well, I'd like to get the video done. What exciting thing could happen between now and the end of the year? And then, of course, the market drops 1,000 points in one day. But of course, the year is not just one day. It's 365 days, it's many weeks, and of course, from an investment point of view, it's many years strung together, which really boils down to some of the fundamentals that I repeat over and over again, which is you've got to know what your duration, what your time horizon is of your money. If it's long, that's completely different than if you need money next week, next month, or even next year. So that is one of the most important and deciding factors in your investment decisions as you reach your financial goals. Now, I always like to think of this as, what are those fundamentals? We get into the weeds sometimes, and I'm going to get into them here as part of my review, and a little bit of, hey, what are the variables that we're going to watch going forward? So I'm going to come back time and time again throughout this video about what are the fundamentals, which is to be invested. So the very first graph that I've got up there is by decile, the last 96 years of the S&P 500, which is an unmanaged stock market index. You're going to see, if you look at all those, that there's a skewness, a preference for positive returns. Actually, 73% of the returns are positive, whereas, of course, 28% are not positive, zero or down. And so that's important because we've got to ask ourselves, hey, do I have my investments always worried about the steps back? Do we take 3 steps forward and 1 step back? Or do I worry so much about that step back that I also give up the 3 steps forward? There's only 1% of the time that it's been more than 40%. And as a matter of fact, there's only 6% where it's been, really horrible. Nobody likes those. But then when we look at all the others, it's painful. That's why I get back to one of the fundamentals. If you need the money in a short term, a year, 2 or 3, absolutely, you should think about the risk level and whether or not that's something that you would be willing to take. So we have a skewness towards the positive in the markets. And in 2024, it was very positive across the board, whether it is the unmanaged stock market indexes, domestic or international, or the bond indexes. So just a wonderful year. The next chart I want to point out is that's what we're looking at from an investment point of view. And you're going to see that last little bit there is 2024. I mean, we've had a wonderful run up, even when you consider, 2020. We've had a wonderful, run up, and we've got the PE ratio of about 22 right now. And many times people say, well, with a PE ratio of 22, that means that the markets might come down. I'm going to show this next graph here, and it is above average, the 22. However, there's 2 ways that it can revert to the mean. One is that the prices come down or the earnings go up. And I'm going to make a proclamation here today that I believe that the earnings are going to go up to make that number go down, and not the prices going down. I think that there's some fundamental shifts going on from an economy point of view, an economic point of view, that we haven't seen in 30 years. And it is all of the advances in technology, especially as it relates to artificial intelligence, the large language models, and how that's going to kind of seep into everything that our economy is doing. I remember when I was in college in the late 80s, I used to write out, in long form, my, my thesis, my speeches, but my papers. We also used to have to add and subtract on a piece of paper. Now we have spreadsheets. Now we have Microsoft Word or pages in the Apple world, and how efficient that has made so many businesses that have just propelled the um, the earnings ratio for companies. I think we're going to have the same revolution going forward. In that going forward, and we're just scratching the surface. So it's going to be my belief, and what I'm going to say to you is that is the price going to go down, or the earnings going to go up to meet those prices and to justify those prices? And I believe it's going to be the latter. Uh, the Magnificent Seven, which are some of the biggest technology firms, have done very well. They have, I'm highlighting it there right now, which is the earnings ratio. I believe that the profit margins, not the earnings ratio, the profit margins are going to continue to stay very nice, if not go higher. So this bodes well for those of us that have that long-term time horizon. I want to just take a break here for a second. If you say to yourself, hey, I don't have a long-term time horizon, my answer would be you probably do. Even if you are 65 years old and you're about to retire, you still have many decades, hopefully, statistically, to live. And so you've got to remember that there's many 5 and 10-year time horizons until you and your significant other, if you have one, that you might pass on. But if you say, I don't want to take any risk, I don't want, that even though the probability is historically that it's going to be positive, not negative, I don't want to take that risk, give me a call, because there are some investment vehicles out there, some products, I suppose, that do have floors. And so we can find something that might work for you. I don't read minds. So if your mind has changed, your mindscape, um, your belief, your risk tolerance has decreased or changed in some fashion, you've got to let me know so that we can adjust accordingly. Um, Inflation has gone down, which is wonderful. It has gone down. I believe it's probably going to continue to go down, but that's what the Fed is working on right now. They have just made a proclamation that they're going to maybe slow down in 2025. The rate decreases. We'll see. We'll see how it plays out. It's hard to predict out a whole year, but of course we don't make our change our philosophy on what the Fed says in one day for 1 year. I don't believe that we're going to see the zero interest rate environment like we have, back in the, right after the Great Recession. But as you can see there, and I've just kind of circled and highlighted it, it has continued to go down over the last, couple of years, and is expected to continue to go down. I would think that as well. That's good for especially mortgage rates. Those of you who want to buy and sell a house, real estate. People who have existing bonds. That's a good thing. As interest rates go down, the prices, have a tendency to go up for existing bonds. So that's a good thing, especially when we have a portfolio that is stock and bonds put together. You're going to see here, especially on that right-hand side, that bonds had a tough year a couple years ago, tough couple of years. And the last couple of years have been positive. The unmanaged aggregate, the Bloomberg U.S. aggregate for the bond indexes, but it's still been pretty lame this year, especially compared to what the equity markets have done. But it still makes sense to mesh them together because as interest rates continue to go down, it's my belief that the bonds will go up, and so in the right portfolio, it still does make sense. So let's not get too negative on them going forward. This, I think, is one of the key and fundamental charts that we always have to keep in mind. What that is on the 1 year on the left-hand side is the range going back, 50, 60 years to 1950. So I guess that's over 73 years of the green is 100% U.S. Unmanaged stock market index. It's the bond is the middle one, that blue one, and then the gray is 50-50 unmanaged stock market index, unmanaged bond index shoved together. What's important is when you look at the 5, 10, and the 20 year, how the highs go down, the lows come up. When you've had a 50-50 blended portfolio, there actually has never been a 5-year time horizon going back 73 years where you haven't at least broken even and even made 1%. So that's what we got to keep in mind. Has there been 1 years where a blended portfolio has lost money? Absolutely. We can see that by those bars on the left-hand side. But when we blend them together, we start to have, at least historically, something that has the worst has not been that bad. And so that's what we've got to keep in mind. So that being said, 2024 was a wonderful year just across the board, which kind of follows up with the 2023, which was a great year, but 2022 was horrible. So we've got now that a horrible year in 2022, but 23 and 24 have been wonderful. 2025, we have a new administration, but let's not forget the president is not all powerful. I do think, getting back to that, I think the technology changes that we're going to see filter through from the technology firms through all of manufacturing and service business, changing our daily lives is going to be a motivating factor both in 2025, 26 going forward as well. But we will see. We don't change our portfolio for 1 year. We don't change because of a new administration. We don't let our politics dictate our investment philosophy, but it is good to know what the long-term trend might be. And I believe the technology advances that we're seeing is going to be one of the most important variables for the foreseeable future. Michael Brady, Generosity Wealth Management, 303-747-6455. I hope you have a wonderful new year, have had it by the time you get this, and that we have a wonderful 2025. Thank you very much.